Hello everyone, welcome back to RBI and welcome to Finance Current Affairs session. In today's session, we are going to discuss a very important publication that has been released by the Reserve Bank of India, that is the State Finances, a study of budgets of 2022-23. So the Reserve Bank of India has provided the highlights for this publication, and there is much important data that has been provided by the Reserve Bank of India through the highlights, as well as this important data has been shown in the newspapers also. So it becomes very important for you to understand the highlights that has been presented by the RBI for the publication, what this publication is all about, as well as what is the important data that has been provided by the Reserve Bank of India. So in today's session, we are going to understand the complete highlights and we are going to understand the data. But before that, there is a big announcement from EduTab that we have brought for you the comprehensive guide for RBI, NABARD and SEBI. So through a single guidebook, you can get all your common queries answered. If you want to know about the examination, that what is the pattern for the exam, what is the syllabus for the exam, what are the previous year cutoff for the exam. So all these common queries can be answered through a single guidebook, and you can even have the knowledge that what should be the sources for the preparation, what should be the strategy for the preparation, as well as this is absolutely free of cost for you all, and you do not have to visit different links, you do not have to visit different websites, okay? And this is absolutely free of cost for you all to save your time, to save your effort, and you can easily download these guidebooks. The link is provided in the description box below. So do download these guidebooks. They are going to enhance the level of your understanding for the examination, okay? So now coming to the study of budgets, that is of 2022-23. So this is a publication, that is the annual publication of the Reserve Bank of India, that provides the data and the analysis of the fiscal position of the financial status of the state governments in India. So this publication is released every year to show us the data and the analysis for the fiscal position of the state governments in India. So now this particular publication that is released in January 16, 2023. So this publication provides us the information, analysis and the assessment of the finances of the state government, of the fiscal position of the state government for the 2022-23 through the budget estimates. And here in this publication, there is the comparison that has been made with the budgetary operations of the 2021, where the actual data has been provided, and with the 2021-22, for which the provisional accounts or the revised estimates has been provided. So we are going to see the information, analysis and assessment of the finances of state governments for 2022-23 with the comparison to the dynamics of the budgetary operation of the state governments during these two periods. Okay, so we are going to compare the data now. So now there is one more important thing that you should know about this publication, that is there is the theme that has been provided by the Reserve Bank of India for this report, that is the capital formation in India, the role of states. So here we are going to focus on the capital formation, which is the theme of this report, of this publication that has been released by the Reserve Bank of India. So here we are going to see the role of states in the capital formation, in the asset formation, we can say. So now starting with the highlights that has been provided by the Reserve Bank of India. So the Reserve Bank of India through this report has said that there was deterioration, there was the negative effect that was coming in the financial health or the fiscal health of the states during the COVID situation. So the pandemic induced deterioration was happening in 2020-21, from which now the states has improved. Okay, so the fiscal health of the states has improved from a deterioration that was happening in 2020-21, and this improvement has come from the broad-based economic recovery that we are seeing now. We can see that the demand is increasing, the investment is happening more in the country, the credit growth is quite high. So we can see that there is economic recovery that is happening. The supply chain disruptions are also reducing in the country and resulting high revenue collections. The revenue collections has also improved, and due to this, the fiscal health of the states has improved. So now coming to state's gross fiscal deficit, that also tells us the fiscal health of the state. Okay, so the fiscal deficit, first of all, what is deficit? Deficit is when your expenditure is more than your receipts. That is, whatever you are earning, from that you are spending more. your expenditure is 120 while your earning is only 100. So of course this 20 rupees is the deficit that you are making. So similarly, there is the state's gross fiscal deficit. Now fiscal deficit can be calculated through the total expenditure minus the total revenue excluding borrowings. So here we want to see that what the state government total expenditure is, and from that we are deducting the total receipts that the state governments are getting excluding the borrowing. So we are not including the receipts, the borrowing receipts, okay. Or we can say that the total expenditure minus the total receipts include the revenue receipts that the government get from the taxes, that the government get from the fines, plus the non-debt creating capital receipts, okay. So total expenditure minus the revenue receipts plus the non-debt creating capital receipts, and we are deducting it from the total expenditure to see the fiscal deficit of the states. So this is the formula. I hope you already know the fiscal deficit. If you do not know the fiscal deficit, it is just the total expenditure minus the total receipts excluding borrowings, okay. So the state's gross fiscal deficit is budgeted to decline, is provisioned to decline, and that is a good news for the states. So in 2022-23, the provision is, or the budget is showing, is estimating that there will be 3.4% of the fiscal deficit of the GDP. 3.4% of the GDP will be the fiscal deficit, that is lower than the fiscal deficit of 4.1% of the GDP that was seen in 2020-21. So the fiscal deficit for the states is going to go down, that is the gross fiscal deficit is going to go down, and that is a good thing for the states. So now coming to, while states debt is budgeted to ease to 29.5% of GDP in 2022-23. So we can see that the debt is going to reduce, that is the state's debt is budgeted, it is estimated that the debt is going to ease, debt is going to reduce to 29.5% of the GDP, which was before 31.1% of the GDP in 2020-21. So we can see that the debt is going to ease, the debt is going to reduce to 29.5% of the GDP in the 2022-23 as per the estimates. If we compare it with the actual data of 2022-21, that was 31.1% of GDP. Though we have to remember that still this number is very high. As per the FRBM review committee, it is still higher than the 20% recommended by the FRBM review committee. So we can see that the 29.5% of the GDP, that is the debt that the states are taking. So of course it is still higher than what the FRBM review committee has recommended, that is 20%. So here warranting prioritization of debt consolidation. So what we need to do now is we need to consolidate the debts. So the small debts that are taken by the states, that should be paid back through a bigger loan that the state can take, and this bigger loan will have better terms and conditions for the states, that will be easier for the states to pay back. So this is the debt consolidation. Debt consolidation means consolidate the smaller loans, bring together the smaller loans and make it a new loan so that it becomes better for you to pay it back, okay. So it becomes easier for you to pay it back because you will have favorable term structure in the new loan. So debt consolidation means combining more than one debt obligation into a new loan. So the new loan will be a bigger loan, we can say, with a favorable term structure. You will have favorable terms and conditions. Favorable term structure will be there, lower interest rate will be there, tenure will be good. So here the amount received from the new loan is used to pay off the other debts, okay. So here is the concept of debt consolidation that the states can do to get a new loan with the better term structure and with the favorable conditions, we can say, and through that the states can slowly reduce their percentage of the GDP that they are putting in the debt, that they are taking from in the form of debt. Now coming to states have budgeted higher capital outlay. So the states are estimating that we will do higher capital outlay, that we will do higher capital expenditure. So that is a good news, because the capital expenditure, that means the assets will be formed, okay. So that is a good thing that the states are showing that they will do higher capital outlay, they will do higher capital expenditure. So they will be creating more assets for their states, and this is higher than the 2019, 2020 and the previous financial years. So now going forward, the increased allocations can be made to the sectors like the health, education, the physical infrastructure can be improved of the states, and the green energy transition can happen, and this will help to improve the productive capacity. This will improve the production of the state because the infrastructure will be improved, as well as this will provide better human capital to the states because the health and the education can improve. So you can understand that this can create a very good effect for the country. But here the states have to mainstream the capital planning. The states have to do good capital planning. Usually what happens that the state governments, whatever the revenue that they are getting, they first spend it on their consumption. They first put it for their consumption. Then they put this revenue to the salaries that they have to pay. Then after that, after paying everything, they put the money to the asset making, to the assets, that is to build the infrastructure, to build the schools, to build the hospitals and so. So you can understand that the state government is not prioritizing the assets. That is very important for the states to prioritize. So here the capital planning is treated as residual. It is treated as something that we can neglect. We have to focus on paying the salaries. We have to focus on our consumption, and we can neglect the capital. So first stop cutbacks are made to the assets only. If the budgetary targets are not being made, there is the first stop cutbacks to the budget of the assets that are being made. That is, first, if the budgets are not being met, if the expenditure is happening too much and the revenue is not happening that much, so what the states usually do, they cut their budget for the assets and they show that okay, the budgetary target is being met. So that is a very bad practice that the states are doing. So now the data shows, and as per the report, that is the state finances, this shows that the state's capital the capital expenditure to the GDP is going to increase. So that is a good news that we can hear, that the states are going to increase their expenditure on the capital, on the asset making, on the physical assets. So here it is going to increase to 2.9% as compared to the previous 2.3% that was seen in 2021-22 as per the provisional accounts. Okay, so here we can see that okay, the capital expenditure is going to increase as the percentage of GDP. So next highlight is, it is worthwhile to consider creating a capex buffer fund. So we have to make a capital expenditure buffer fund. Usually what happens that there are times of boom in the economy and there are times of downturn in the economy. So this is the upturn that is happening in economy when the revenue flow to the government is quite high. When the revenue flow of the government is quite high, then there comes the downturn in the economy when the revenue flow to the governments is quite low. So now here is the need to make a fund for the capital expenditure. So this fund will be made for the capital expenditure, where during the time of the boom, where during the time of high revenue flow, the money will be saved in this fund, so that this money can be utilized when the revenue flows are less. Okay, so that the capital or the assets can be continuously formed in the states. So this is what this is saying. It is worthwhile to consider creating a capital expenditure buffer fund during good times when revenue flows are strong, so as to smoothen and maintain the expenditure quality in the capital assets and the flows to the capital assets through the economic cycle, so that we can pass the economic cycle easily and we can continue the capital expenditure in the, that is, we can continue making the assets. So this is a recommendation that has been given in the report, we can see. So now we have to, in the report it is said that the crowd in of the private investment, that is the increase in the private investment has to be made. That is, the state governments should boost or should improve the quality of the ecosystem that they are providing, so that the private investment can increase in their states. So there should be a good ecosystem, there should be a good environment that should be provided to the private investors for the private sector to thrive. Okay, so the states have to focus on that also, and when good infrastructure will be in your state, of course the private investors will come to invest in your states. States also need to encourage the interstate trade, and that should be also facilitated, because when a state has good infrastructure, when a state has good warehouses, when a state has good roads and good port system or waterways, so you can understand that there can be much business that can happen in that state, because there is good infrastructure in that state. So the full benefit should be taken from that state, and the spillover effect will be very good on the other states also, because there is much economy, there is higher economic activities that can take place in this state that has good infrastructure. So the spillover effects are quite good for the state capex across the country. So the state that is doing the capital expenditure and has the good capital, so from there the spillover effects can go to other states also through the business activities, through the higher economic activities, and through the good interstate trade. So this also has to be facilitated by the state governments only. Okay. So now this report has been prepared in the Division of State Finance of the Department of Economic and Policy Research, that is DEPR, under the supervision of Dr. Sitikanta, that is the Executive Director. So I hope you have understood the highlights. The data points has also been provided, so try to remember those data points that are the important data points, and what has been said for the capital formation. That is, it is very important. It will create the spillover effects. You need to increase the private investment also, so that the private sector can also thrive. So these are the statements that has been made in the highlights of the RBI for the state finances. So I hope you have understood these very well. The theme you need to remember. So this is the question for that, and you need to remember the state's debt that is budgeted to ease to what percentage. So the percentages you need to remember. Okay, and remember that what is the recommended percentage for the debt percentage of the GDP. What is the recommended percentage by the FRBM review committee? So this also is an important percentage that you must know. Okay, so thank you very much. I hope you have understood today's session very well, and do subscribe to our YouTube channel and join our Telegram channel for the PDF of today's session. If you have any query, you can mail us here, or you can contact us through this number. Thank you very much, everyone.